get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast.
People argue that you cannot tax billionaires on the shares that they hold in a company because it is an unrealized gain. So they go like, yeah, you're worth 300 billion, but we can't tax you on those stocks because you haven't sold the shares. And I understand the argument. They go like, no, you don't have it. It's just what it's worth because it could also crash and then you have nothing, so we can't tax you on it. Then I'm like, okay, I understand. Then Elon Musk offers to buy Twitter. In his offer, he goes, I'm putting up my Tesla stock as collateral. So you do have it. Then he's like, no, I don't have it. So then they accept the offer. He now buys Twitter. Now that they've accepted his offer, he now goes to private equity and banks and like other rich people and whatever. He goes like, can you guys borrow me the money to buy Twitter? Because I don't want to sell any of my Tesla shares. But then they're like, what are we loaning it against? And he's like, well, my Tesla shares. Then I'm going like, wait, so you can buy a thing based on what you have. Yes, but when we want to tax you, you can say, I don't have it.
Yeah, welcome to episode 72 of the Financial Purpose Podcast. That monologue is from Trevor Noah, and I saw that over the weekend, and it just kind of struck the right chord with me. I've been watching, just kind of finishing the series Billions, which is a great show, and I'm currently in the last season, and the character of the Chuck Rhodes, who is the district attorney, is on a massive kind of holy war against billionaire capitalist. He went after the primary character, Bobby Axelrod. Bobby Axelrod fled the country. Now he's going after the successor, Billionaire. And that is, I forget his name now. It's Mike Prince is the name. And so I'm watching that. I saw this Trevor Noah thing, and I thought, you know what? I want to talk about some of the myths that surround billionaires and income and their taxes. And I specifically want to take issue with this monologue from Trevor Noah. So there's some bold claims in there about how billionaires earn and pay taxes. And people were laughing, and they think it's funny, and it's, you know, it's kind of easy to go after rich people or billionaires and garner a lot of support. But most of what he said actually kind of misses the mark. And so today I want to break down some facts and some real world insights. I'm going to destroy a couple of myths about billionaires, and then we're going to talk about how a lot of what Trevor Noah was just talking about, the average person absolutely can do as well. It's not a billionaire thing. It's what happens when you are building appreciable assets. And so I want to talk about that, because if a billionaire can do it, a lot of times you can do it too. The numbers just look different. They magnify differently. They add up differently because one set of numbers are bigger than another set of numbers, but the strategy remains the same. So I'm going to get right into it. Myth number one is billionaires don't earn quote unquote real income. They don't take salaries. They avoid paying taxes like everybody else. So that's the claim. And the reality is that billionaires often derive a lot of their wealth from asset appreciation, not from traditional income. They hold assets like stocks, real estate, interest in business ownership, and a lot of times, I shouldn't say any and deal in absolutes, but a lot of times an owner or a CEO of a big company, a lot of their wealth is tied to the company's stock and not their actual paycheck. And so that difference definitely affects how and when taxes are applied. So great example is if you look at JP Morgan, CEO Jamie Dimon's been leading the bank for more than 20 years and has been incredibly successful at the helm of what is now one of, if not the world's largest asset managers, consumer banking, commercial banking, trading apparatus, all of it. JP Morgan is a behemoth. And quite honestly, I would argue that Jamie Dimon is one of the heroes coming out of the great financial crisis, because he was ordered through his bank to buy Bank of America, which had failed, and he was able to put up the money. J.P. Morgan put up the money. He stood down the government forces at that time, but of course had to eventually buy those shares. So anyway, his compensation package was just announced as a part of J.P. Morgan's earnings call, and Jamie Dimon's compensation is at $39 million per year. Now, you're going to hear that number and say, well, that's ridiculous. Who the hell should make that much money? Nobody needs that much money. I beg to differ. That is a massive organization. And if you don't pay somebody requisite to the job, you're not going to get top talent at the top of that bank. And if you don't have top talent at the top of that bank, you're going to have some serious issues that are going to be systemic throughout the economy. So pay the man what he's worth. 39 million is the numbers that the board of directors have set. And here's the thing. Of that 39 million, only 1.5 million of that is actual base salary, which makes that 1.5 million taxed at the highest possible rate, because Jamie Dimon is not only in the highest tax bracket, but he's paying the extra non-investment income taxes and all sorts of other things. So 1.5 million base salary, he gets a $5 million cash bonus, and then the remaining 32.5 million is all what's called variable performance share units, or what you and I would understand as stock rights. And so a significant portion, almost all of his income, is tied to the performance of the bank based on the shares that he owns. That's how it works for a lot of these folks. So when you have appreciated assets, unrealized gains, so that means the value of the asset before it's sold, above what you paid for it. So those unrealized gains aren't taxable under current laws. Now, there was a big push last summer under the Harris administration's campaign to consider taxing unrealized gains, which is, I think, a massively problematic mistake. And when you tax unrealized gains prematurely, it absolutely can lead to liquidity issues. It can lead to market disruptions. It's a bad idea. And I'm going to talk more about that as the episode goes on. But I would say, imagine for the average person to think about this, because we always want to talk about the word fair. And when we talk about wealth appreciation and who should get taxed, what amount, the fair share argument always comes up with. The problem I have with it is nobody can define what's fair. So let's boil that down to, kind of the Main Street thing, which is, imagine you own a house, you bought it some number of years ago. The value of the house is way more than you bought it for, and whatever way more is, you can attach your own number to that in your head. But your value is more than what you paid for it. Now, imagine that every year when you file your tax return, you have to report what your home is worth. You might have to get an independent appraisal, or maybe they go on like a Zillow value or a Redfin value or something like that. But whatever the amount of money that you paid for that house, you can adjust your basis by adding in things like replacing the roof and the air conditioning and major improvements. I'm not talking about switching out countertops or painting or, changing the color of your cabinets. I'm talking about like real capital improvements. You add those to how much you paid for the house, and then you subtract that from the value of the house. So imagine having to report that on your tax return every year and paying taxes on it. Does that sound fair? It doesn't sound fair to me. But that's what we're asking people to do, or that's what some people in our country are supporting, that the people who are rich, which again, we need some definition around, should have to pay more, and they should have to pay on unrealized gains. And I think it's a terrible idea. Myth number 2, billionaires don't pay taxes. The claim is that billionaires avoid paying their, again, the word fair share of taxes entirely. So let's get some definition around fair. And I can start naming politicians, but I won't, because that's their favorite word, and none of them have ever defined it. So here's the reality. Billionaires do pay taxes when they realize income. So that's when they receive dividends, which are taxed every year at their ordinary income rate, or when they sell stock, which is taxed If they hold it long enough, it's taxed at a long-term capital gain rate, and that's taxed at a lower rate often than your ordinary or the tax rate at which you earn any dollar of income. Capital gains tax is income from investments that's taxed at lower rates. It incentivizes long-term investments. It fuels economic growth. Example, if any billionaire, millionaire, whoever was to sell stock, they pay up to 20% in federal capital gains tax plus state taxes in some cases. Now, to put that into perspective, most of you listening will pay somewhere between maybe 0% or you'll jump up to 15%, and there is no in between. So I should back that up. You would pay 0% if your income's under a certain level, 15% from mark to mark, and then 20% above that based on stock sales. So most of you are paying less than a millionaire or billionaire or a higher wage earner would pay when they sell stock. Is that fair? You be the judge. So the other thing and the reality with this is that corporations are often owned by people, and those people, especially the larger corporations, they often pay significant corporate taxes before they distribute dividends, before they distribute shares, before they distribute bonuses and whatever. And so that often means that these people are taxed multiple times on the same dollars or a reduction of the dollars of which they're already taxed on. And so tax planning strategies a lot of times get used, like deferring income, bunching deductions, using charitable deductions. That's all legal, and that's all widely used by people at all income levels, and it's just smart. So tax avoidance is smart tax planning. Tax evasion is illegal if you're an average citizen. I'm not sure if it's illegal if you're an elected official. Remains to be seen. Sometimes it is, sometimes it's not. Point is, for those of us who are not in government, it's always illegal, and it's very problematic. So we want to be sure that we're not paying too much in taxes, but we don't want to completely evade tax or try to hide income or try to be shifty with our assets so we don't pay tax, because that's just fundamentally wrong, and we shouldn't do it. Okay, myth number 3. Billionaires should be taxed on their net worth, and here's the claim. Billionaires have so much wealth that they should just pay taxes on their net worth annually. It just should be a thing. Here's the issues. Most billionaire wealth, which is what Trevor Noah was describing in the case of Elon Musk, who is everybody's favorite whipping boy at the moment, most of their wealth is tied to illiquid assets like business value, which is true of most of the business owners that I work with at Life Moves Wealth. Most of their net worth is the business. And that's why we have to work on exit planning and doing certain things to try to diversify where their net worth and wealth is appreciating and growing and where it lives and what type of assets they have. But anyway, business stocks, which are illiquid until we sell them. I mean, I would say the liquidity of the stock market is pretty good. I mean, we have a 1-day settlement term at this point, but it still is illiquid because it often doesn't make sense to just sell because of maybe where the market is, or because of tax realization, or because of income projections, things like that. There's also real estate, which is illiquid. And so taxing net worth on an annual basis could force the sale of assets, which destabilizes markets. Now think about this. You're like, oh, boo-hoo, they would have to sell stuff. Okay. Some of the stuff that's illiquid can't just be sold quickly. A business can't, nor should it, be sold quickly to pay taxes, nor should it be liquidated, a portion of it, to pay net worth taxes to the owner, because that harms the going concern of the business, which harms the employees of the business, which harms the vendors of the business and the suppliers of the business, which harm the consumers of the products that business sells. You see how this gets into a really nasty cycle. Also, a house, I don't know if you've noticed, but houses just don't sell right away, right now. And there's a lot of reasons for that. So, as an example, since Trevor Noah picked on Elon Musk, and like I said, he's the favorite whipping boy at the moment, if he had to sell Tesla shares every year to pay a quote unquote wealth tax, it would absolutely drive down Tesla's stock price, because when there's a high amount of selling, you have to have somebody on the other side to buy it, but they're going to buy it at a lower price because there's a big block of shares that are going through. They're not going to pay full market value for those. So the bid is going to go down, and that's going to impact the average person who has Tesla stock in their portfolio, either their brokerage account, maybe they've put it into their 401k or their IRA or something like that, or it's attached, by the way, it's attached to an index fund that they might own in their kid's 529 plan. Well, now we're impacting asset values because we're instituting a wealth tax, which is going to cause trickle-down selling. Oh, I said trickle down. Shoot, I think that's illegal. Okay, double taxation is another problem, or a reality of taxing people on their net worth, because net worth taxes would essentially be a double tax, because we're taxing people on the amount of income that they earn or the amount of income that they could earn if they liquidate assets. And then we're taxing them on the value of all of those things put together. So it is absolutely a double tax. Now tell me how fair that is. Doesn't sound very fair to me. So proposals like wealth taxes are controversial because, number one, they're difficult to implement. And number two, they will totally discourage entrepreneurship and investment. So if you're one of these people who likes these politicians who continue to talk about wealth inequality, and I'm not here to say wealth inequality isn't a problem, because it is, but you don't get at solving wealth equality by destroying wealth in the process. That's Marxist. That's problematic. That doesn't work. That completely breaks the backbone of the economy that we are accustomed to here in the United States. So if you want this, you need to understand that a lot of things that you enjoy and appreciate on a daily basis, like your iPhone and your Android device and your Netflix subscriptions and things like that, probably are going to come to a halt and may not work so well, because there won't be anybody there to support those devices and subscriptions and channels and content and things like that. So be careful what you wish for here. Myth number 4. Man, I'm like fiery today. I'm in a certain kind of mood where I'm just like not having it. So, okay. Myth number 4, billionaires' wealth only benefits themselves. Here's the claim: billionaires hoard wealth and society sees no benefit. The reality is that these people create jobs because they start companies, they grow companies, they hire more people, they employ other people's companies, right? So they bring on vendors. Those vendors can now employ more people because they're getting more orders from the original company that's growing. And now you see where this, again, it all bleeds back and through the economy, because now those people are spending money at the marketplace or at the grocery store or at the mall or on Amazon or whatever, Etsy, I don't know, wherever you're buying stuff. You're able to spend money because your employer is being employed by the company that's owned by the billionaire that we're now trying to tax, or say that they are only benefiting themselves. So these people create jobs, they drive innovation, they contribute to economic growth, and they benefit from it. But there's a whole chain of people down the line who also benefit from it. Example, a company like Amazon, it employs over 1.5 million people worldwide. In some communities, it's the largest employer. In fact, in a lot of communities, the Amazon warehouse that you rely on to get your 1-day, same-day, or 2-day prime goods might be the largest employer in your region or your town or your city or whatever. And they support thousands of small businesses and small business owners throughout the platform in a lot of different ways. They also provide a lot of web services that businesses rely on as well. And billionaires, usually, if you name a billionaire, I can probably point you to some philanthropy cause or charity or organization that they're part of, or that they've started, or that they have created a foundation to raise money and to benefit a certain cause. So they fund initiatives in education, healthcare, climate change, uh, virology, which was a big deal, over the last 10 years. We've heard a lot about that. They fund after school programs, they fund anti-drug programs. They do a lot of things. Actually, a lot of times these people do more good than the government does. Just put that out there. And so wealth concentration isn't inherently bad because, and I'm sorry, I'm speaking so fast. Wealth concentration isn't inherently bad if it leads to societal benefits. It leads to innovation, leads to charity, and most of the time it does lead to societal benefits. There really aren't a lot of people who are at that level, because once you get to that level, there's a big magnifying glass put on you. And there aren't a lot of people who are just hoarding all of this wealth for themselves. A lot of them are putting it back into the community by buying other businesses or providing jobs or starting charities or putting together these foundations or negotiating partnerships, and they're involved with national businesses to employ people globally, and they're doing a lot of good. So there may be a few, like, I don't know, uncanny, like, bad people out there, some villains if we want to have them, but they're very, very few and far between. And so here's the thing. Those are the myths that are often spread by billionaires. Usually we hear more about it during an election campaign. Usually it's from one side of the election. I'll say usually it's from one side of the political spectrum. That's probably a better way to say it, because they need to create a boogeyman for people to glob onto, to be afraid of, that they need to save you from. And so a great boogeyman always is the wealthy person. I mean, when we're kids, we learn the story of Robin Hood, and Robin Hood is this great character. I happen to think he's not. I happen to have not really enjoyed my children reading that story because I don't think it's a good story. And so, people that we make heroes often aren't the best heroes. And usually it's because they're attacking some form of wealth. In Robin Hood's case, you're attacking the crown. Okay, maybe I can let that go. But if you're stealing from the rich to give to the poor, how about we just don't steal and we create partnerships? So the average person can use the same strategies that a lot of billionaires use, and a lot of millionaires use, and a lot of people who are on the lower end of what we would call millionaire status. And you'd actually be surprised how many people have more than $1 million of net worth simply because of their personal residence and some investments and their 401k and maybe the cars, or maybe some personal assets, or maybe some bank savings. You'd be surprised. And so let's not attack people with an M or a B behind their net worth, okay? So the first way that you can, as an average person, and define whatever average is however you like, you can use some of the same strategies by investing in appreciating assets. So you're going to grow wealth by holding assets like stocks, real estate, businesses, these things that increase in value over time. You can focus on investing things that grow long term. As I've said multiple times on this podcast and other episodes, wealth is not built by day trading alone. A lot of people who employ these, crazy day trading tactics and these, triple leverage things and whatever, and they don't stay up on them. It's very difficult to do that successfully without a lot of help and without a big apparatus behind you, pushing data, pushing sell signals, pushing buy signals, moving a lot of money in and out of the market. The average day trader does not make any money, and they often do not build any net worth or any appreciating assets as such. So a diversified stock portfolio is great. Real estate's great. A business that you can buy into or start yourself is great. You can use tax advantaged funds or accounts. Places like 401ks, IRAs, HSAs is a great hidden gem in anybody's retirement plan. Roth IRAs are a great way to invest money that will eventually be completely tax free. And you can either do it if your income is below a certain level by directly contributing to a Roth IRA. If it's above a certain level, you can look at the potential to do a backdoor Roth contribution. And so there's a lot of different ways to maximize savings and let your investments grow either tax free or significantly tax deferred. And that's how you build wealth over time. The second thing you can do is you can leverage capital gains tax rates. And so what the wealthiest people do is they sell assets strategically at very specific times. Sometimes they wait a year or two to sell assets based on the timing of when they acquired the asset. And they do that strategically to take advantage of lower long-term tax rates compared to higher, typically ordinary income tax rates. And so what you can do and how you can do this is simply hold investments for more than a year, especially if it's in a taxable brokerage account, before you sell them so you can qualify for lower long-term capital gains tax rate. If you are holding stocks in a retirement account, you're not taxed when you sell those. There's no capital gain or capital loss that's realized. It's simply just value in, value out. But if it's in a brokerage account or something taxable, if you sell that investment in less than a year's time, you're going to be taxed at a higher rate because it's going to be at your ordinary tax rate. The tax bracket that you fall into minus your deductions, you're going to pay that tax rate, not the lower capital gains rate. So using capital gains and capital losses to your advantage is a great way to minimize tax liability. Another way, third way you can do it is borrow against assets instead of selling them. This is exactly what Trevor Noah was complaining about. And what wealthy people do is they borrow against their assets like stocks or real estate to access cash without triggering a taxable event. So I talk about this all the time with real estate. For the people who are super, super anxious to pay off a mortgage super, super fast, what you're doing is you're burying your net worth, or I should say it maybe a little bit nicer. You're transferring liquid net worth to illiquid net worth, and it's sitting in the walls and the floor and the roof of your home. And there's only two ways to get access to that cash. The first way is to borrow against it. The second way is to sell the home or the asset or the piece of real estate or the land or whatever it is. So, you could do that. You can do that. It doesn't cost you any money. You don't pay taxes when you borrow against the assets that you own because you're not selling them, which is smart. It's smart tax strategy. It's a smart way to leverage an appreciating asset. And these strategies can be used at the appropriate time for the appropriate reasons and work out really well for you. So there are people who talk about bad debt, leveraging your assets to buy or acquire another asset, or to do something that's going to push your net worth needle along, or to free yourself up from a much higher cost piece of debt, maybe. There's all sorts of strategies for where this makes sense. Maybe you need a short-term liquidation strategy to buy a house or to buy a vehicle or to pay off or buy out maybe a business partner so you can take on more shares of the equity of your business, which appreciates your net worth and gives you more ownership and more stock in that business, if you will. So oftentimes that's way better than selling the asset, selling stocks, selling the real estate, selling the business, selling a portion of the business. To fund a major expense, sometimes just borrow against it. If interest rates are favorable and you can float the debt service, meaning you can make the payments without it wrecking your cash flow, that's going to allow you to do what you need to do, and it's going to keep your investments growing and it's gonna avoid unnecessary taxes at that time frame. I've had several clients use these strategies, not only just with home equity as an example, but borrowing against their stocks. You can do it either with a pledged asset loan, or it might be called a securities backed line of credit, or it might be called a margin loan, something like that. You can borrow against your stock holdings once you have a certain level of investments, and it's less than you might be thinking, but you can borrow against them and do what you need to do. You can have a credit line so you can go secure another asset or whatever. And if you need to pay the line back, you either make the payments or you sell the investments when it makes sense to pay back that line of credit. So it's smart, if you use leverage smartly, to use leverage. Did I say that in a weird order? It's smart to use leverage if you use leverage the right way. So the fourth thing you can do is you can utilize business ownership. There's a lot of advantages, and you can use them to your advantage. And so a lot of these millionaires and billionaires, they get there because they own businesses. It allows them to reinvest profits and take advantage of some tax related benefits through the business. And so what you can do is you can, I don't know, start a business, or if you own a business, you can work with professionals who can help you understand ways that you may be able to maximize the tax benefits or the earning benefits or profit maximization benefits in your business, which maybe this is a good segue. I can do this real quick. I can talk about, if you want to know how to do this, February 25th, the Business Transition Summit. That was an awkward segue maybe, but it's a good one nonetheless. Business Transition Summit, if you are in the mindset of maximizing your current business or growing, you're going to learn good ways to maximize profit. You're going to learn how to protect your mental health and the mental health of your people. You're going to learn how to improve your sales methodology to get better results. And if you're of the mindset that you want to start planning your business exit, which, by the way, as soon as you start a business, you should be planning for the exit strategy, because that exit strategy that you intend for it should drive how you run the business along the way, because you can't just run the business and hope for good results and then try to sell it. You need to begin with the end in mind, as Stephen Covey said, and the Business Transition Summit will help you understand how to do that as a business owner. So February 25th, go to businesstransitionsummit.com. Early bird pricing ends February 1st. That's coming up. That's like just a couple of days from when you hear the sound of my voice on this particular episode. It's coming quick. Use code LIFEMOVES at checkout to get an extra $100 off the current ticket price. If you miss early bird pricing, you have until February 14th to get your ticket for the Business Transition Summit here in Scottsdale, Arizona, February 25th. It's going to be an excellent day. Go to businesstransitionssummit.com to learn more. Okay, so there's a lot of advantages to being a business owner. I talked about taxes. I talked about reinvesting profits. I talked about understanding how to maximize profitability. All of these things generate long-term wealth for you as the business owner. And owning a business can be a great strategy for you. There's some people who are most comfortable being an employee and having the ability to work for somebody who is successful. And there are some people who need to be the person who is successful. They need to be the one that's driving the charge. They need to be the one that owns the business and leads the business. And the key here is surround yourself with good professionals. Get a great financial advisor. Get a great tax planning advisor or CPA, and then put them in a room together at least once a year and ask them to work cohesively on your tax strategy. It's the best thing that you can do for yourself and for your business, and it's a wonderful way to invest in quality people who will help you grow your net worth over time. Okay, number 5, and we're kind of coming up here on the last couple of points here. Number 5, there's a lot of tax benefits from being philanthropic. So wealthy people donate appreciated assets to charities. I have clients who are at the age where they have to take a required minimum distribution. And instead of taking that money for themselves, they take a qualified charitable deduction and they just donate the money from their IRA or 401k straight to charity or to a donor advised fund, which then donates to the charity. And so these people get a tax deduction for being charitable. Why not? Let's use it. If it incentivizes people to be charitable, let's incentivize them to do that. And so, um, when you do those strategies, you donate directly from an appreciated asset. You avoid paying capital gains taxes. The charity doesn't pay capital gains taxes, and so you're able to maximize your donation, and they're able to maximize the money they receive from selling that donation so they can put it into their programming. It's a fantastic thing to do. So if you're charitably minded, using your retirement assets once you're at a certain age is a great way to do it. Or if you have cash that you're donating, maybe consider a donor advised fund over just donating cash directly. There may be some benefits. You are able to grow your contributions by investing them, and then you're able to continue to maximize year over year your impact because there's more money at play, more money than what you've donated, and that can be very beneficial to the charities that you're supporting. So there's some great philanthropic ways to benefit both tax-wise and also to put it right back in your community. And as I've said before, if you're a person who's earning and you have a positive cash flow and you have free cash flow, and you're in your community, please do not just be a consumer of your community. Go be a contributor. Put money back into the community that you care about. Do it through the organizations that make your heart beat faster, and you're going to benefit a lot more people that way. Again, a lot of people do this. They're not hoarding their wealth. They're donating money into charity, and they're giving money away to other organizations who benefit the people who need it more than they do. This happens all the time. Finally, number 6, there's some estate planning techniques that you can use that the wealthy people use, things like trust, gifting strategies. All of these things minimize estate taxes and they transfer wealth efficiently. And everybody needs to be thinking about transferring wealth efficiently, because if you don't decide where you want your assets and money that you've worked so hard to accumulate in your life and put it down on paper, if you don't decide that ahead of time, your county and state will happily decide that for you, and they'll charge your family and loved ones for the courtesy of deciding where your money goes, called probate. So don't do that. You can set up trust. You can maximize annual gift exclusions to give money to people that you care about, kids, nephews, nieces, whoever, your children. You can gift in 2025 up to $19,000 before there's any gift tax. And also, in 2025, your estate tax exclusion for an individual is $13.99 million. So if you have less than $13.99 million of assets, you're not going to have to worry about tripping over that estate tax exclusion, which means you don't have to do very complex wealth planning, and you don't have to do some of these funky life insurance policies that people talk about on social media as being the way that the Rockefellers transfer wealth. If you don't have higher than $13.99 million of wealth, some of those strategies may not actually apply to you, and they may not directly benefit you. Asset protection trust, if you don't have that high amount of wealth, it might not benefit you to irrevocably send your money somewhere else into an entity that dictates how you can get it back, if you can even get it back, and how much per year. It may not make sense for you to do some of these things that take money out of your estate if you don't have that high level of assets. So good, solid estate planning. Again, if you have a great financial advisor and a great tax professional, they're going to bring in a great estate planning attorney, and the three of them are going to sit in a room together and help you do what's in your best interest, and then document it and make sure that it's legally competent to stand any kind of contestation from an outside party or a debtor trying to make a claim on your assets. There are ways that you can minimize exposure to your assets, saves your family a lot of money in taxes and legal fees and things like that after you pass. So the strategies that billionaires use aren't exclusive to billionaires. or millionaires. They're available and accessible at literally any income level with the right planning and the right tools and the right people that are helping you, helping guide you through those processes. So the key is, of course, to start early, be intentional, know what it is that you're trying to accomplish, educate yourself on how to do these things correctly. And then there reaches a point where you need to be really good at what you do and pay somebody who's really good at what they do to help you get to where you want to go. So it's really easy, kind of as I close here, it's easy to criticize people who are wealthy. It makes great comedy. It's great monologue. It gets a lot of likes. It gets a lot of attention because we all have, the politics of envy can really grab at a lot of us emotionally. But I'm going to tell you the nuances of tax planning and income planning and wealth planning. It requires deeper analysis and a deeper understanding than what most of the people who are talking about it actually know. So I think if Trevor Noah got a little bit more education, or maybe when he's off camera, he feels differently. I don't know. But I think if you educate yourself just a little bit more than what you grab on social media in a quick soundbite or off a comedy special or from a politician, of all people, the last person you should listen to in that regard is a politician, because all they are trying to do is garner enough of your emotion to buy your vote. That's all they care about. They don't care about you. They don't care about making your life better. They don't really care about attacking the rich people. They care about getting your vote so they can stay in power. They themselves are enriched when they stay in power. So let's make sure that we are being at least discerning enough to understand who's giving the message, why are they saying what they're saying, what's the reasoning behind, what is it that they want from me, and what is it that I'm supposed to do with this information. If you can have that level of discernment, you can cut through a lot of the BS that gets said in the news media and on social media and at the water cooler and at a political rally and all that stuff. And by the way, political rallies, God, what a big waste of time, my personal opinion. Anyway, so I'm curious, because you've heard my opinion on this bleed out throughout the episode. I clearly am on the side of leave people with wealth alone, tax them appropriately. In fact, I'm in favor of a flat tax. If we all want to have a flat tax where we're all paying the same rate of tax, but just understanding that the dollar amounts are different, I really could get behind that, because that cuts out some of this inequality talk, and it cuts out some of the people who think that, there needs to be a higher percentage on certain people than a lower percentage on other people. But then once you actually get your tax rebates and credits and deductions and whatever, then you actually pay no tax into the system. Like, I get this. I would much rather have a flat tax. So that's my opinion. My opinion is leave the wealthy alone. They're taxed at a higher rate anyway. They're paying tax multiple times on the dollars. They're using legal strategies to avoid a high amount of taxation in certain time periods. They're using legal leverage strategies to maximize their ability to borrow against the assets that they own, even if they don't have them in their possession or they can't be taxed on them because they're illiquid, like your house, Trevor Noah, right? You don't want to be taxed on your house. Don't try to tax somebody's investment account because they haven't sold it yet. You can do those things, those leverage things, legally, and they make sense, and you can wrap estate planning around it to protect those assets when you go. So I'm curious. Send an email to info@lifemoveswealth.com or comments on whatever platform you're hearing or watching this episode. What do you think about how billionaires should be taxed? So I'd love to have a conversation. I will be objective, even though I have a bias. My job as an advisor is to check my bias and be objective, because it's the only way that we're going to get to the best solution for you, regardless of what my bias is. My bias may inform what I think, and it may inform how I advise, but if my bias doesn't line up for what's right for you and what makes your situation better, then I need to drop my bias and get a little more education and be objective. And so I would ask you to do the same thing. Be objective, but tell me, What do you think about how billionaires are taxed? What do you think about the sound clip at the start of this episode? And what are some things that you think we could do to sort of ease this societal tension around wealth inequality, around how people should be taxed, etc.? I'd love to hear your opinion. info@lifemoveswealth.com, or go ahead and comment on the episode. If you agree and you liked everything I said, go ahead and hit that like button wherever you're listening to this. Subscribe to the podcast if you aren't already. Share it with people who would appreciate hearing this message. And I'll look for you on the next episode. So until then, go be financially awesome. Take care. See ya. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.